10.51 is the disruptible conduct provision that I talked about, and so watch out for that. Scenario 3. OPR receives a referral from an examining agent who determines the preparer of an income tax return has given the taxpayer an opinion on the presence of substantial authority. Agent disagrees and finds preparer advisor did not follow 10.37. Remember, that's the current provision governing all written advice. Agent's position is the practitioner unreasonably relied upon the facts presented by the taxpayer. Remember that one? We just talked about the ability to rely on facts from the taxpayer and what are your duties of due diligence. Facts so presented were in fact incorrect, and practitioner accepted them without verification. Well, were there any indicators as to whether you should have verified them further? Was there something inconsistent that would have given you a clue? How might OPR handle this? Well, OPR receives that complaint and it sends a proposal that you be disciplined for not following 10.37. You then are entitled to secure representation, and you can come back and say, I was entitled to rely upon the facts that the taxpayer gave me. There was nothing inconsistent. I relied upon them, and I gave good faith advice based upon it. I did not know that the client was misrepresenting the facts to me. That would be your defense. Whether or not that would be believed, that's the next step. If it's not believed, you are entitled to a hearing before discipline is imposed against you by OPR. 4. Smith engages you in 2015 to represent her before the IRS with respect to income tax liabilities for 2010 to 13. Has minimal assets, earns about $80,000 a year, is a mid-level manager for a large company. Tax liability resulted because she was claiming too many dependents and had too little withholding taken out. You gather financial information for your client. You do a financial statement. The 433 lists a residence with value of $300,000 with a $295,000 mortgage, a personal vehicle with Kelley Blue Book value of $10,000, and a balance of $14,000. Not unusual that people have cars that are upside down. The financial statement is given to the revenue officer, and the revenue officer has been considering the appropriate amount. Soon thereafter, the revenue officer calls you and says, your client failed to disclose all assets. She notes that when she pulled the credit bureau report, the following items were missing from the financial statement. A 2003 Corvette, a 2012 Harley Davidson, a condominium in Lake Geneva, Wisconsin. Well, everybody forgets their condominium, with an assessor's value of $200,000 and with a mortgage of $125,000. Subsequent call, the revenue officer, you call your client who confirms that she failed to disclose the assets listed above. She believes the Corvette is worth $5,000 and it's paid for. The Harley Davidson is worth $15,000 and has no encumbrances, and the approximate stated value stated by the revenue officer for the Wisconsin property was accurate. So she lied through her teeth to you when you did the financial statement. What do you got to do? What are your duties now that you've determined that the 433A is inaccurate? Remember the rule 10.21. You got to tell her the ramifications of this inaccurate return and say, if you don't correct this, the IRS might choose to pursue you criminally. It certainly is not going to grant you an installment grant. What are your duties to the taxman? You cannot continue to negotiate as if this is accurate now that you know it's inaccurate. If the taxpayer refuses to correct her mistakes, you have no choice but to send a letter to the IRS saying, I'm withdrawing as power of attorney for this taxpayer. You cannot go on with the representation when the client will not correct the material misstatements on the financial statement. What must the preparer tell our client? We discussed that. 10.21, knowledge of a client's omission. You know it's wrong, you should tell her to correct it. What if any conflicts might exist? The taxpayer might, if she refuses to correct it, say you told her to lie. So that's another reason that you want to get out, because you got the 10.29 problems. You have diligence as to accuracy. Should you have had clues that she had a Harley Davidson, a Corvette, and a home in Wisconsin? Probably not, but if you had reviewed her tax return and there were large deductions above that that would have been ordinary for her home taxes and her home mortgage on her individual private residence, it should have led to a question, why are you deducting so much for home interest and home taxes on your tax return? It might have led you to the property in Wisconsin. So maybe you weren't as diligent as you should have been. All of those are dangers. And so, bottom line, if the taxpayer doesn't correct it, get out, because you could be dragged into this client's dishonesty and get yourself into big problems. Scenario 5. Sid and Mary Castle of Indianapolis engage you in 2014 respect to unpaid taxes for 09 to 12. Total liability due is in excess of $250,000. Since your engagement, you have engaged in negotiation with an attempt to secure an installment agreement. As part of the negotiation, you have covered a 433A from the parties, secured a 433 and submitted to the revenue officer. That 433A indicates the Sid is a sole proprietor, that his net profit is $180,000 per year. Mary's a school teacher, she makes $50,000 a year. The Castles have joint assets that are fairly minimal other than their home. The home has a $300,000 value and $150,000 mortgage on it. It is held in joint tenancy. In March of 2000, you receive a call from Mary stating the parties have irreconcilable differences and she has filed for divorce. She states that she really trusts you and would like you to continue negotiating with the IRS. Now what do? Guess what? The fact situation changed. Remember our conflict of interest rules. Your duties now change with the divorce proceeding. You are in a potential conflict of interest. You're going to have to tell the taxpayer the potential conflict. You should tell the wife, since they are both liable, and the husband, if they want you to continue, they need a waiver of the conflict of interest to be given to you. And if they don't give that to you, your best interest is to withdraw. You want express consent from the interested parties, because now she may want to try an innocent spouse. She may want to raise other defenses like it's all his fault, it's all from his income as self-employed. I had withholding from my check as a teacher, and it's inequitable to make me pay, therefore I should get separation of liability, equitable relief of separation of liability. So you need those consents, a verbal consent followed within 30 days, but in no event more than 30 days. Scenario 6. An attorney advises two of your business clients of a planning for selling the business that involves a complex multi-tier LLC structure to accomplish both estate and income tax savings as they enter retirement. The attorney drafts a research memo for you and the client covering the plan's technical aspects. You review the memo and present your arguments to the attorney that the LLC may be deemed a related party or controlled group of the IRS and thereby negating any tax advantage. You agree that the plan has some merits but are concerned the IRS issue recent rules requiring disclosure of such transaction. You are also concerned that clients' willingness to participate in the transactions may not have a more likely than not probability of success. Should you prepare a return adopting the tax attorney's position? If so, how can you manage the client's expectation about potential penalty to you and the client that may result? What you telling? You got to tell them that if you don't believe the position of the attorney, and you don't believe that you can get to a position required by the code, which is at least substantial authority, that if you're going to take that position, you'll need to put a disclosure statement on the form saying to the IRS, you might want to look at this item. We don't know if we can meet the standard. But I would want a written opinion from the attorney, and if I still did not accept it or did not have confidence in it as the preparer, I would tell my client that I would only do the tax return with that position with a full disclosure to the IRS on a form 8275. What are the conflicts? Well, if the IRS begins and disallows this, they may assert penalties against you for a preparer penalty for not meeting the standards of 10.22.